Hi there, this is Chapter 10 video lectures, and we will be in 3 separate PowerPoint presentations. And you will see a table of contents to your left, and you can you don't have to watch the whole lecture, you can flip from section to section. So let's get started. Liabilities. This chapter includes current liabilities, and it also includes long-term liabilities. This first video lecture is for current liabilities. Then we'll move on to bonds. I find bonds really interesting as an investment instrument, and most of us don't know anything about bonds. So this will be a good opportunity for you to learn about bonds. All right, so here we're going to talk about current liabilities, notes payables, unearned revenue, sales tax. We're going to look at the definition of current liabilities. So let's get started. Current liabilities, what makes them current are liabilities that are due within 1 year. Current liabilities are due within 1 year or the operating cycle, whichever is longer. So, 2 months, 3 months, 4 months, it's a current liability. Most of our accounts payable, you guys should be really familiar with accounts payable from Accounting 201. We're not really going to talk about that much in this class, but in the United States, most accounts payable are due in 30 days. And if you work at Costco, if you sell to Costco, their terms are anything from 45 to 60. And if you sell to Walmart, the Walmart company, I think, is 60 to 90 days. So interesting. If you're bigger, you can have longer terms. But for the most people, most companies, it's 30 days. So it's due within 1 year or less. Most companies' operating cycle is much shorter than 1 year. And thinking about operating cycle, you can review that in Accounting 201. So how do we pay the debt? We pay it with existing current assets, cash, or we create new debts. Let's talk about notes payable. Now, notes payable are not the same as accounts payable. Accounts payable, yes, they're a bill, and yes, there are terms on that bill. But a note is when you borrow money. You're not getting inventory for it, you're getting cash for it. So very liquid asset. There's always interest associated with a note payable unless it's your grandmother that loans you the money and doesn't charge you interest. It's a promise to pay. It's not necessarily 30 days. It can be 30, 60, 90, whatever, up to 1 year. So let's take an example. Let's do the accounting for a note. On March 1st, Jorge Esteves borrows $100,000 from First National Bank on a 4-month 12% note. We're going to do the journal entry, we're going to accrue interest, and we're going to pay off the note and the interest. In this example, the interest is not due until the 4 months are up. So even though you incur interest each month, you don't pay it until the 4 months are up. All right, so what happens when you borrow money? You get cash, so cash goes up. Cash goes up, that is a debit of $100,000 because the normal balance for cash and all assets are debits. Note payable also increases, and that normal balance for liabilities is a credit, so that's shown as a credit here. Okay, so 4 months of interest on $100,000. You would calculate, whenever you see interest, it's an annual rate. So it's as if you borrowed it for a year. But we didn't borrow it for a year. We only borrowed it for 4 months. So you have to prorate it. So you'd take the $100,000 times 12%, and then times 4 months out of the 12 months equals $4,000. So on June 30th, the note isn't due yet. When is the note due? Not till July 1st. So June 30th, we're booking the interest expense for the 4 months, and we're assuming they didn't book any entries the other months. Maybe they just publish financials every 4 months, or maybe twice a year, June 30th and December 30th. But at any rate, we're booking it for the whole 4 months. So we're going to charge interest expense, and there we go, $4,000. And what have we done when we've charged interest expense? We have increased expenses, which is going to lower our profit, but we're not paying the interest yet, so we're going to charge the liability, the short-term liability, to interest payable. Okay. Well, we got to pay off this loan. We borrowed it on March 1st. It's due July 1st, so here we go. We're going to clear out notes payable. We had a credit balance there. Now we're debiting it, so now it's got a zero balance for that note. We're going to debit interest payable for $4,000, and we're going to pay off the note, and it's $104,000. So to borrow $100,000 cost us $4,000. That was the cost of that debt. And as a reminder, in my class, when you do journal entries on exams, always put a description underneath them. Okay, let's move on to sales tax payable. Sales tax, wonderful thing, sales tax. So you, as companies, when we make a sale, we have to charge sales tax, unless, of course, you live in Oregon, which doesn't have a sales tax. That's why for those of us in Washington run over to Oregon to buy our stuff. So it's a percent usually where we shop, for most of us shop. The price we see in the store might be $10, but when it's rung up at the cash register, it's $10.90 or whatever the sales tax is. So the deal is we pay the retailer. We pay Safeway or we pay Nordstrom $10.90. Well, if it was Nordstrom, it would be a lot more, but we pay Nordstrom $10.90. Nordstrom keeps the $10, but they're obligated to write a check over to the state of Washington for the sales tax of 90 cents. If you don't, pay sales tax, if you fail to charge the customer for sales tax, so you come to the counter, you charge $10, the customer pays $10, you, the retailer, is still liable for the sales tax. So they will assume that the $10 includes sales tax and charge you for it. So be careful of that. All right, so you're at the cash register at the Macrina Bakery, and the Macrina Bakery says we had sales of $10,000 today. That's a little unrealistic, but we'll go with it. And we had sales taxes of $600. And we know that the Macrina Bakery is in actually is in Seattle, and the sales tax higher, but we'll make this a simple example. Okay, the journal entry would be cash. They would show that they collected cash of $10,600, but they're only going to count sales of $10,000, and they're going to set up an account, sales tax payable, and they have to pay the government for that.